Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 66 on June the 15th, 2019. I'm your host, Eric. And in this week's show, we will cover the trades from last week on Luckin Coffee, Activision Blizzard, and Occidental Petroleum. And we discussed three new trades on Coty Inc., United States Steel, and the S&P Oil and Gas Exploration and Production ETF. Now, it's always great to hear from listeners, so if you have any questions about the trades presented here, or even about your own positions, feel free to email me. You can reach me at eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a short video series to teach you all the basics of option trading you'll need to be able to understand to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Feel free to subscribe as well. Now, this was a pretty slow week in the equity markets. Both equity indices rose roughly 0.4%. It's not much at all. The Dow Jones Industrial Average crawled 105 points higher, ending the week at 26,089 points. The S&P 500 index finished the week 13 points higher, closing at 2,886 points. Now, the topic of the week is sponsored by the Option Studio. If you want to learn to trade options without any calculus and confusing language, visit the website to learn more about the online course. Visit www.theoptionstudio.com for more information. Now, the topic of the week this week is about risk. As a trader, your number one task is to manage risk. We can all find trades or ideas that will make millions of dollars, but if the losses along the way deplete your capital, you won't have a chance to learn the lessons you have to learn in the market to make large profits when the opportunities come. And in this situation, I'm defining risk as the amount of possible financial loss you could have from a trade. So we're going to take a little quiz on risk. Definitely try to answer the questions in your mind, even write them down on paper, and I'll cover the answers after each question. So, number one. Which trade is riskier, buying a share of stock or buying a call option? Well, here's the answer. So hopefully you answered that. The reality of it is stock can always go to zero. So the amount of risk for a share of stock is the full amount of money you paid for it. And if you don't think stock can go to zero, I will refer you to several large companies that have gone to zero in my lifetime. Enron, WorldCom, Lehman Brothers, Bear Stearns. We can think of a few others. And some of you will say, well, they didn't go to zero, but effectively they did. We could be technical beyond that. But the truth of the matter is an option can't lose any more money than the price that you paid for it. Options don't go negative, just like stock don't go negative. So if I pay $5 for a stock, for an option, the most I can lose is $500 because each option has an equivalent share value of 100. So a $5 option is $500. And that's the most I could ever lose. Number two, which trade is riskier? Selling stock short or buying a put option? Once again, options can't lose more money than what you pay for them. So buying a put option, for whatever amount of money you pay for that put, that's the most that you can ever lose on it. So there's a defined loss from the start. Selling a stock short actually has an infinite possible loss because stock can go up, in theory, to infinity. They can only go down to zero. So your gain on selling a stock short is limited. But the loss on selling a stock short is actually unlimited. Question number three, buying a stock spread, meaning buying two companies, buying one and selling the other, sort of like if you wanted to play Google versus Microsoft, or Microsoft versus Dell, or something along those lines. So buying a stock spread, which trade is riskier, buying a stock spread or buying an option spread? And in this situation, I'm defining an option spread the way we do on this show, where you're buying on the same company. That may have given the answer away. So a stock price is actually based on multiple variables. You have the management team, you have the actual business, and the fundamentals there, like supply chain. You've got any news relative to those individual stocks. So the relationships between companies can change dramatically because there isn't a lot of fundamental factors that are maintaining the relationship or requiring that relationship between the companies to exist. However, when you buy an option spread, you can't lose more money than you paid for the option spread. So again, buying an option spread and even selling an option spread, both of those have a defined gain and a defined loss. And then my question number 4, this one will be a little more advanced because I'm going to talk about commodities a little bit and futures trading. But many of you know I have an energy and commodities background, and they get a little bit more intricate. So that's why this is going to be an advanced question. So which trade is riskier, trading a futures time spread or a calendar option spread? And I'm defining a futures time spread as a spread that is in different expiration months on the same product. So let's say we're talking about oil. We're going to trade a July versus September futures trade, or a July versus September calendar option spread on the same thing, on crude oil. And this is a little trickier, like I said. So futures time spreads are based on fundamentals like storage value and then supply and demand. Topics like contango and backwardation are at play, and I'll define those another time if anyone is interested. I know many of you are focused on equity, so I won't go too deep into that. But calendar options, option spreads, are based on time value that's priced into the option itself, along with any other factors that are priced into that spread, priced into that option spread, including all of the fundamentals of the underlying commodity. So I actually think you can manage the future spread easier than you can manage the calendar option spread. So this was a little bit of a trick question. Each month in options, specifically on futures, but even in equities at times, depending on if there's news, each month trades as its own product. So it's almost like trading two similar companies rather than trading the exact same product. Whereas if you take a commodity like crude oil or even gold or silver, something along those lines, they are the same product, just based on the time of year. There are other fundamentals that will affect it. Now, if you trade, say, gasoline or say diesel, something where the actual specification, the actual spec of the product is different from one season to the next, that can have some serious implications on supply and demand, and therefore affect, it's almost like trading two different products as well. But again, that's neither here nor there for this show. It's just a little play from my background, because I didn't want you to think that the answer was always the option or the option spread. But what I do want to point out and reiterate is that, contrary to what you've been told, option trading is not the riskiest. Honestly, if you understand risk, option trading gives you so many more elements, so many more factors and levers that you can play with in order to control your risk. That's why each week you don't hear me freak out about any losses that happen, because normally there's another play, another way for me to mitigate that loss and control my risk. So moral of the story is, definitely invest and take time in learning more about options. And the fact that you guys are here each week listening to me, that's a great start, because if you listen long enough, you're going to learn a thing or two. And if you have questions, like I said, just email me. I love engaging. I love talking to you guys. And thank you for those of you who email me each week, because It's pretty cool for a guy like me. So let's get into the trade review of last week's trade. So we'll start off with Luckin Coffee, basically the Chinese Starbucks, symbol LK, Larry Kevin. Last week when we looked at the trade, the stock was at $18.99. We looked at buying that stock and selling the June 20 call, collecting $1.15, hoping to yield an 11% return in 2 weeks. Well, Luckin Coffee rose 24 cents per share this week, closing at $19.23 on Friday. The call option we sold could actually be repurchased today for 70 cents, which would allow us to lock in a 45-cent profit. In total, this trade made, if you closed it out, this trade made 69 cents this week. Now remember, the strike price is $20 on this option, so if the stock price is under $20 per share by this time next week, we keep the entire amount of money we collected when we sold the call option. That's $1.15. In other words, your best trade at this point is to simply wait it out. Even if the stock goes back to $18.99, the premium on the call option still represents a total of 6% gain on your capital in 2 weeks. That's pretty good. Of course, if the stock goes through $20, that makes our gain 11% in 2 weeks on our capital. But a 6% gain in 2 weeks, pretty nice. Not even counting the movement in the stock. Now, our second trade from last week was a credit spread. We looked at a credit spread on Activision Blizzard, the gaming company. The symbol is ATVI, Adam, Thomas, Victor, Isaac. Stock at the time was trading for $45.38. We looked at selling that June 46.5 call spread and collecting 14 cents, which gives us a maximum possible loss of 36 cents per spread. Now, Activision Blizzard stock finished the week 24 cents per share higher, closing at $45.62. The call spread which we sold would cost us 21 cents to buy back and close. That would mark a 7 cents loss on the week. Now, with only 1 week left in this expiration month, because June expiration is this upcoming Friday, I would simply hold on to the position and not change anything. If the stock rose another 24 cents next week, that would mean it would close at $45.86 per share. The call spread which you sold would finish completely out of the money, allowing you to keep the full 14 cents you collected when you sold the spread. So this one is worth staying in with some caution to daily stock price movement. So trading stock options is not, even if it's a spread option, it's not really a passive investment, especially with 1 week left to expiration. Definitely keep an eye on this and see what happens. And our final trade on the week last week was a debit spread on Occidental Petroleum, symbol OXY, Oscar X-Way Yellow. The stock at the time was $47.84. And we bought the June 48.5/48 put spread for 34 cents, which could yield a maximum gain of 16 cents or 47% in 2 weeks on your capital. So Occidental stock rose $1.47 this week, closing at $49.31 per share. The put spread, which we bought, is now worth 11 cents per spread, making it a loss of 23 cents per spread. We paid 34 cents for the spread and have lost 2/3 of the value so far. You could close this trade out and maybe sell two 48.5 put spreads and collect a total of 30 cents, which would offset the loss that you received. It would more than offset the loss with 1 week left to expiration. Now, when I look at the stock chart, each time the price has reached upward towards the 20-day moving average, the stock has fallen back lower. Since we only have 1 week left until expiration, I'm willing to stay in this spread and see if I get the move in the stock over the next 2 or 3 business days. If the stock continues to move higher, I would like to close this spread, close the position all around, and find a spread to sell that will offset my losses prior to the end of this June expiration. So we only have 5 business days left in June expiration. So this one, if you want to just walk away, you can obviously close it out. and keep the 11 cents that's left in the spread, take the 23-cent hit. But I'd rather actually wait and see what this stock does. I am not a bull on this stock at all. The downward trend has been pretty solid, so I'm expecting it to hold and move forward. So that's it on last week's trade review. Let's look at the trades for this week. Now, of course, we have, I'll say one more time, 1 week left in June, before June expiration. So if you have any June positions, 1 week from now, they will either trade for their intrinsic value or they will be worth zero, which is great for anything that you've sold. All of the new trades this week will be on July expiration, which is 5 weeks from now. So we'll start off with the covered call. I'm looking at a company called Coty Inc., symbol COTY, Charles Oscar Thomas Yellow. This is a conglomerate of beauty brands, many of whom you would know. The stock ended the week for $13.58, and I'm looking at buying that stock and selling the July 14 call at 50 cents, which could yield a 6.77% return in 5 weeks. Now, you enter this trade by buying Coty stock for $13.58 and selling the July 14 call at 50 cents. This trade makes the most money if stock prices finish above $14 per share. The break-even price on this is $13.08. Our credit spread for the week is going to be on another familiar name, United States Steel, symbol X as in X-ray. Their stock ended the week at $13.78. I'm looking at selling the July 14-15 call spread at 37 cents, which could have a possible loss, a maximum loss of 63 cents. Now, you enter this trade by selling the July 14 call at 80 cents and then buying concurrently the July 15 call for 43 cents. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices stay below $14 per share. The break-even price on this trade is $14.37. And then our final trade on the week is a debit spread on the S&P Oil and Gas Exploration and Production ETF, symbol XOP, X-ray Oscar Paul. Stock ended the week at $24.96, and I'm looking at buying the July 26-25 put spread, paying 60 cents. That could yield a maximum gain of 40 cents per spread or 66.67% return on your capital in 5 weeks. You enter this trade by buying the July 26 put for $1.72 and concurrently selling the July 25 put at $1.12. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices stay below $25 per share. The break-even price on this is $25.40 per share. That is it for this week. I hope you guys enjoyed the quiz. If you didn't actually take the quiz, even though you know the answers, go back and take the quiz again and then listen to the answers again, because the goal for me is to teach you guys how to trade options and how to not lose money in that process, or at least mitigate your losses. So have a great week. Happy trading. Take care. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.